Hi there, welcome to an A2 micro revision talk on the question, what is dynamic efficiency? So dynamic efficiency is best described by the pace of innovation in a market over time. It's whether the producers in an industry are meeting people's changing needs and wants from one time period to another. So really the key to understanding dynamic efficiency is that it happens over time rather than a point in time. And right at the heart of dynamic efficiency is the concept of innovation. Innovation can be defined in various ways. My preferred definition and interpretation is that innovation is putting a new idea or approach into action. Innovation is the commercially successful exploitation of ideas. The Austrian school had a lot to say about innovation, in particular the famous economist Joseph Schumpeter, who coined the term creative destruction, in which new businesses, new business models, new products oftentimes challenge the existing dominance of market players, and smaller businesses can sometimes scale very quickly and ebb away at the monopoly power of existing firms. And we see lots of creative destruction in the economy at the moment, particularly in digital industries. We can make a distinction in terms of dynamic efficiency between product innovation, which is where you see small scale, often frequent, subtle improvements and changes to a product, constant iterations of a particular product, such as the iPhone, and process innovation, which is a change in the way that businesses get their products to market. Perhaps they become more efficient in delivering the product to the consumer. They may have a more interesting and dynamic business model, maybe a dynamic pricing strategy which is different to existing players. So in that sense, process innovation can be seen as part of productive efficiency in the long run. Now, the key, I think, to understanding dynamic efficiency is the use of profit. So supernormal profit, shown here in the diagram, is when the price is above the average cost of production. The firm is making a rate of return higher than the minimum it needs to stay in a particular industry or market. And in imperfectly competitive markets such as monopoly and oligopoly, and to a lesser extent in monopolistic competition, the supernormal profits in the long run may be a factor helping a faster rate of technological development, which can reduce costs and crucially can produce better quality products for consumers. So in that sense, monopoly power can be good for innovation in the long run. Monopoly power can be positive for dynamic efficiency. The key, of course, is how profits are used and whether or not firms who are making high levels of profit are actually being dynamically efficient themselves and applying for patents on the leading edge of the technological frontier. Here's just a few examples, I think, of dynamic efficiency in action in the last year or so. Quite a few restaurants and credit card companies are now trialling the use of robots, multilingual robots in their restaurants. It's quite interesting for consumer service. Xiaomi, the Chinese smartphone maker, is now introducing a cut price drone of less than $700, designed to undercut the existing market leader. Porsche is making significant investments, as indeed many companies are, in the electric car, and in this case electric sports car market, trying to challenge the dominance of the early dominance of Tesla. Big investment from Ford, multi-billion-dollar investment to expand the fleet of plug-in and hybrid electric vehicles. And in big investments in industries which are trying to develop quick charge batteries, wireless charging, and next generation of batteries which have much more power before they need to be recharged. I think all of these examples in this slide are good examples of dynamic efficiency in action. This is quite an interesting chart. It shows the number of the top 10 firms in the United States in receipt of patents. So commercial patents, of course, is a factor driving innovation, driving dynamic efficiency. IBM right up there. Notice there that Samsung was second. This is just in the United States. Canon, Google is spending a lot of money trying to re-engineer the web. Toshiba, Sony, LG. So quite a few South Korean companies in there, along with the usual suspects, Intel and Microsoft. While these are big firms, they all have significant market positions. In most cases are highly profitable. And clearly the bigger scaled profitable businesses have the financial resources to win many patent races. And here's a good example of a market which is constantly changing. It's growing rapidly, of course, the global wearables market. And these were the top 5 sellers of wearables in 2015 globally in terms of millions of units. Fitbit's the market leader. Apple is in there. Garmin, of course, has been in there a long, long time, and Samsung. This is a market, I think, which is essentially oligopolistic. There are clearly barriers to entry, but it's a market, I think you would probably agree with me, is likely to be quite dynamically efficient, because over time we're getting many, many new types of products, development of software that goes with them, functionality and performance in time is clearly going to improve. It's a fast-changing market, and therefore it's a market which is dynamically efficient. So hopefully that gives you an idea or two as to what we mean in a market by dynamic efficiency. The key is the pace of innovation in the industry.